In 1720, a man named John Blunt convinced the British government to let him pay off their national debt. He wasn't a banker, he wasn't royalty. He was the director of a trading company that had never actually traded anything. Within 6 months, he'd made himself one of the richest men in England. Within a year, he destroyed the savings of nearly everyone who trusted him. And the entire scheme was completely legal because Parliament had written a law specifically designed to make it work. His name has been mostly forgotten, but the financial weapon he used, something called a joint stock company, changed the world in ways we're still dealing with today. Let me show you how one man, one law, and one spectacular lie turned ordinary people into millionaires and paupers in the space of a single summer. John Blunt wasn't born rich. His father was a shoemaker in Rochester. Blunt apprenticed as a scrivener, basically a guy who copied legal documents by hand. He was smart, ambitious, and spent his 20s watching wealthy men get wealthier while he scratched out a living with ink-stained fingers. By 1711, he'd worked his way into a position at the South Sea Company, a new trading venture that had a government charter to trade with Spanish colonies in South America. On paper, this was a gold mine. Spain controlled vast territories rich with silver, sugar, and slaves. If Britain could tap into that market, fortunes would be made. Blunt became a director, then the lead director, and somewhere along the way, he realized something crucial. It didn't matter if the company ever actually traded anything. What mattered was that people believed it would. Because here's the thing about joint stock companies in 1720. They were new. Most people didn't understand how they worked. You could buy shares, little pieces of ownership, and if the company made profits, you'd get dividends. If the share price went up, you could sell for more than you paid. But the share price wasn't based on actual profits. It was based on what people thought the company might be worth someday. And Blunt understood that better than anyone. In 1719, Britain had a problem. The national debt from decades of war was crushing them. The government owed millions of pounds to thousands of creditors, and the interest payments alone were eating up a third of tax revenue. Blunt walked into Parliament with a proposal. He told them the South Sea Company would take over the national debt. The government would stop paying interest to all those individual creditors. Instead, they'd pay the South Sea Company, and the company would handle everything. In exchange, the company would get to issue new shares and sell them to the public. Parliament loved this idea. It would simplify their bookkeeping, reduce their immediate costs, and make the debt someone else's problem. They passed the South Sea Act in April 2020, and that's when Blunt's plan kicked into high gear. Here's how the scheme worked, step by step. The government's creditors, the people who'd loaned money to Britain over the years, were offered a deal. They could convert their government bonds into South Sea Company stock. The company would value the bonds at face value, and you'd get shares in return. Sounds fair, right? But here's the trick. The share price wasn't fixed. Blunt controlled when shares were issued and how many, and he realized that if he could drive the share price up before converting the debt, he could issue fewer shares and keep the difference. So he started a whisper campaign. He spread rumors about the company's incredible prospects in South America. He talked about ships being built, warehouses full of goods, trade deals being negotiated with Spain. None of it was true. The company had sent exactly one trade mission to South America, and it had failed miserably. But nobody checked. The share price started climbing. In January 1720, South Sea Company stock traded at £128 per share. By May, it hit 550. By June, it was over 1,000. People were selling everything they owned to buy shares. Dukes, merchants, maids, clergymen, everyone wanted in. There were records of people mortgaging their homes, borrowing money at predatory rates, even selling family heirlooms to get cash for shares. And Blunt kept feeding the frenzy.
He did something else too, something darker. He started bribing members of Parliament. Not with cash, with shares. He gave them stock at insider prices, far below what the public was paying. When those MPs sold their shares a few weeks later, they made fortunes. The king's mistresses got shares. The Chancellor of the Exchequer got shares. Even the king himself bought in. Blunt had turned the entire government into accomplices. And because everyone in power was profiting, nobody asked questions. Nobody demanded to see the company's books. Nobody wondered why a company that had never made a profit was suddenly worth more than the entire GDP of some European countries. The law Blunt was using, the joint stock company structure, was designed to spread risk and allow regular people to invest in big ventures. It was supposed to democratize wealth. Instead, Blunt had weaponized it. By August 1720, the South Sea Company was valued at over £300 million. To put that in perspective, that's roughly £60 billion in today's money for a company that owned a handful of ships and had completed maybe a dozen trade runs. And then people started doing math. A few skeptics, investors who'd been around long enough to smell something wrong, started asking basic questions. Where were the profits? Where were the trade goods? If the company was converting all this government debt into shares and the share price kept rising, how exactly were they planning to pay dividends? The answers didn't add up. In September, a banker named Archibald Hutchison published a pamphlet breaking down the numbers. He showed that even if the South Sea Company captured every single trade route in South America and operated at maximum efficiency for a decade, it still couldn't justify its current share price. The stock started to fall. At first, it was slow, a few percentage points here and there. But then, panic set in. People who'd bought shares at £1,000 tried to sell at 900, then 800, then 700. But there were no buyers. Everyone was trying to sell at once, and the price collapsed. By December, shares that had traded for over £1,000 in the summer were worth less than 200. Thousands of people were ruined overnight. Blunt, of course, had sold most of his shares at the peak. He'd walked away with a fortune estimated at over £180,000, enough to live like royalty for the rest of his life. But the scandal was too big to ignore. Parliament launched an investigation. They discovered the bribes, the insider trading, the complete lack of actual trade activity. Blunt was arrested, his assets were seized, and he was publicly humiliated. He kept about £5,000 in the end, enough to live comfortably but not extravagantly. He died in 1733, bitter and mostly forgotten. But here's the thing that haunts me about this story. Blunt didn't break any laws. Everything he did was technically legal under the South Sea Act. The joint stock company structure allowed him to issue shares at will. There were no regulations requiring companies to disclose their finances, no insider trading laws. Bribing politicians was frowned upon, sure, but it wasn't criminal. The law had created a playground for financial manipulation, and Blunt had just been smart enough to see it.
The South Sea Bubble, as it came to be known, destroyed lives across every social class. Isaac Newton, the scientist who discovered gravity and revolutionized mathematics, lost £20,000 in the crash. He later said he could calculate the motions of heavenly bodies, but not the madness of people. A poet named John Gay wrote about servants who'd briefly become richer than their masters, only to end up in debtor's prison when the bubble burst. There are records of suicides, families torn apart, elderly people who'd invested their life savings dying in poverty. And the people who'd gotten rich, the ones who'd sold at the peak, became targets of rage. There were calls for executions. Mobs gathered outside the homes of South Sea Company directors. Parliament eventually passed the Bubble Act, making it illegal to create joint stock companies without explicit government approval. It was a panicked attempt to prevent another disaster, but the damage was done. Here's what I keep coming back to. John Blunt wasn't a criminal mastermind. He didn't hack the system or operate in shadows. He just read the law, understood its loopholes, and exploited them with ruthless efficiency. The South Sea Act was written by smart people who thought they were solving a real problem. Britain's debt was crushing them. A public-private partnership seemed innovative. Letting ordinary people invest in the company seemed fair.
Nobody imagined that the law would enable one man to create a financial weapon that could wipe out generational wealth in a matter of weeks. And here's the uncomfortable truth. We're still using the same basic structure today. Joint stock companies are now called corporations. They're everywhere. And the core mechanism, selling shares to the public based on projected future value, is identical to what Blunt used in 1720. We've added regulations, sure. Insider trading is illegal now. Companies have to disclose their finances. But the fundamental game is the same. You're still buying pieces of companies based on what you think they might be worth someday. And the people running those companies still have every incentive to make you believe they're worth more than they are. In 2008, we had another bubble. Banks were selling mortgage-backed securities, complicated financial products that nobody really understood, and the housing market collapsed when people realized the underlying assets were worthless. In 2021, we had meme stocks. Retail investors drove up the price of failing companies like GameStop based purely on hype and momentum, not fundamentals. In 2022, cryptocurrency exchanges collapsed, wiping out billions in customer funds. The pitch had been the same. Get in early, the price will only go up, trust us. Every single time, the mechanism is identical to what Blunt used in 1720. Create something people don't fully understand, convince them it's valuable, drive the price up through hype and momentum, sell before it crashes. And every single time, the people who get hurt are the ones who believed the hype. Blunt died wealthy enough to be comfortable, but not wealthy enough to be remembered as anything other than a cautionary tale. The South Sea Company limped along for another century, eventually fading into irrelevance. The government debt it was supposed to solve was quietly restructured in more traditional ways. But the law that enabled the whole disaster, the joint stock company structure, became the foundation of modern capitalism. And that's what I can't shake. The same legal tool that destroyed thousands of lives in 1720 is the same tool we use to build our economy today. We've patched some of the worst exploits, added guardrails, created regulatory agencies, but the core vulnerability is still there. Because at the end of the day, a law is just words on paper. It can enable innovation or destruction, often at the same time. And it only takes one person, someone smart and ruthless and willing to push boundaries, to find the exploit nobody else saw coming. John Blunt found his in 1720. Who's finding theirs right now?